Okay, let's talk about the factors that shift the bond demand curve. Yeah, there are several factors that will change the demand for the bond, may increase or may reduce. In order to better understand those factors, you have to treat yourself as investors who are interested in buying a bond. Then it's easier for you to understand all those factors. So treat yourself as a bond investors. So let's look at the factor wealth. If wealth increase, what happened? It means you have more money. If you have more money, are you going to spend more money investing in the bond? Probably yes. So as a result, the bond demand will increase. If a bond demand increase, it will shift the bond demand curve to the right. The second factor is expected return on the bonds. So if you expect the bond return go up, as an investors, are you happy? You probably will be attractive to bond investment because higher return you expect, you will buy more bond. So which means bond demand will increase, will shift the bond demand curve to the right. Expected inflation rate. How this affect bond demand? In order to answer this, you have to recall one of the equations we learned in the previous chapter is called the Fisher equation. Real interest rate equal nominal interest rate subtract expected inflation rate. Remember, investors look at the real interest rate to determine whether to invest or not invest into the one asset. So here you see the expected inflation rate pi e goes up. If nominal interest rate remain the same, it will reduce the real interest rate. So lower real interest rate, lower return. Are you going to buy bond? Probably not. So that's the reason the bond demand here will decrease, because the higher inflation rate lead to the lower the bond return. As a result, the bond demand curve will shift to the left. Expected return on other assets. So here, keep in mind, when we say other assets, because as investors, you always has choice to invest into the bonds versus other assets. Other assets like stock, like gold, and many other assets you can invest into it. If the expected return on other assets increase, so return on those assets increase, are you going to still invest into the bonds? Yeah, here you treat the bonds and other assets as a substitute. The higher expected return on other assets will attract you to put more money into other assets. So which means you will reduce the money you spend on the bonds. So it will decrease the bond demand, remember. So other assets and the bonds are substitute. Because bond demand reduced, the whole demand curve will shift to the left. The risk of the bonds relatively to other assets increase. So risk go up. What happened? Here, in economics, we have one basic assumption is we are the risk averse persons. So which means we dislike risk. So if the risk of the bond investment go up, we are not going to put our money into the bond. We are going to reduce the investment in the bond. So that's the reason bond demand will go down, which shift the bond demand curve to the left. What about the liquidity of the bond? For investors, would you prefer the high liquidity or low liquidity? Liquidity means how fast you can convert the one asset into cash. As investors, we always prefer the high liquidity. So if liquidity of the bond increase, people will buy more bond. So which means bond demand increase. Remember, if the demand increase, it always means the demand curve shift to the right. The last factor may affect the bond demand is information cost. Yeah, when you invest into the bond, you have to do the homework to study what kind of the bond you want to invest, what kind of the risk you will face. If the information cost of the buying bond or investing into the bond increase, you are going to spend more time and money study the bond. Are you going to buy more bond? Probably not. So the higher cost will actually reduce the bond demand. And keep in mind, if the bond demand reduce, the curve always shift to the left. So please remember all these factors that will shift the bond demand curve.